George Salamis, President and CEO of Integra Resources. Integra Resources is a New York Stock Exchange listed gold producer, gold project developer, focused on the Western U.S., the Great Basin of the Western U.S., one heap leach mining operation currently in production with two on the way from a development perspective. 10 million ounces in the ground, all within 3 hours, three assets, 3 hours of each other.
George, good to see you. Been far too long. I hope you're well. We are going to talk about you as a gold producer.
Indeed.
That's not bad. In this environment, not a bad thing to be.
Indeed. Fresh, new, 3 months into gold production. We're banging the drum loudly, reminding people that we're actually producing with cash flow. Ended the year with over $50 million in the treasury because of it. All good stuff.
Okay, well, we'll start with the kind of high-level stuff, and then we're going to deep dive here. But we're talking about Florida Canyon. You picked that up. I think 100% owner now. Is that right?
Correct. Yes. Yeah.
Well done. So tell us a little bit about Florida Canyon. What have you got?
Yeah. So the genesis of acquiring Florida Canyon came as a result of knocking our heads against a wall for the better part of the last 5 years. As you know, Matt, in the pre-development space, you know, there's a cadence to financing, and the market sees you coming a mile away on that cadence, right? $20 to $30 million every year to advance your development projects. And we were stuck in this loop, as so many are. And so we figured the best way to break that would be to look for a producing asset that will pay the bills, so to speak, on everything else that we have from a development perspective, which is how Florida Canyon came along very fortuitously, I would say. And so we acquired Florida Canyon for $63 million of stock. By the time we closed the acquisition at year end, as a result of the transaction, we had over $50 million in the treasury. So this is transformational for us. Yeah, absolutely. It removes that financing risk element for DeLamar and Nevada North, the two development stage projects, one of which is well on its way to permitting. But for us, the real crux to it, pardon the pun, sorry.
$10 coming your way.
There you go. I could see the dollar sign fly at me on the screen here. The real sort of meat and potatoes of this transaction, if you will, was the ability to sell the vendors on the fact that all of our assets are within 3 hours drive of each other, which means there are a lot of synergies to be had. We can, move people from here to there, deploy talent from the existing mining operation to our other two development projects, maybe some equipment at some point in the future, who knows. But it's really a rarity to have that sort of, three pillars approach so close to each other.
Okay, so you got the synergies and the potential efficiencies there as well. But this is an ATM, right? This is a cash producing asset which is going to help with the other two projects. So let's look at what you've got. You talk about 72,000 ounce production in 2024. That's good news, but 6 years life of mine. So what do you do with that?
So, the first thing, I think the show me element to this story, which will then sort of lead to the re-rate, and there are a bunch of pieces to that, but essentially it's demonstrating, every quarter as a producer that we're actually making money, that our balance sheet is increasing, that we have the ability to self-finance ourselves right to the kind of project financing stage at DeLamar, for example. I think that's mission number one. Hopefully that leads to a re-rate. We do believe it will. We're trading at 0.25 of a PNAV right now, where our peers are twice that. So again, that's not going to happen instantly. It's going to be quarter over quarter of showing that sort of the margins that are being made at Florida Canyon. In addition to that, there's lots of exploration upside to come at Florida Canyon. This is an asset that, for the better part of the last 20 years has not seen, a meter of drill steel in it from an exploration perspective. And there's a lot of low-hanging fruit there. So you'll see the introduction of an exploration thematic to extend that 6-year mine life, Matt, which is going to be really important. I think it's hugely successful as well. And while we're doing that, we're de-risking everything else that we have. So DeLamar is going to enter into the NEPA, sort of the federal regulated permitting process in the U.S. at a time when couldn't be better, in our view, to be permitting assets in the U.S. That'll happen this year. We'll be bringing on a chief operating officer pretty soon here. So it's just kind of the culmination of a number of things that I think are really going to sort of drive value for our shareholders this year.
Right. we'll hit all those talking points, but I want to come back to Florida Canyon one more and
Sure.
how you monetize this. Like say, lots of reasons why it's a good thing. But you mentioned the word margin several times there, and that's one of my favorite words. Is you got to make money. It's not just a case of just churning over money and plowing it back in the ground. So with those 72,000 ounces, with the 6 years life of mine, which you hope to extend, how do you go about? How do you get, one, are you making margin? And two, what do you do with that cash to kind of drive value just in Florida Canyon initially, please, if you don't mind?
Sure. I mean, we're very definitely making margin. I mean, I think a starting point for anybody looking at, what the margins could be, when we contemplated this acquisition, we were looking at estimated cash flows at various gold prices by the time that we would take possession of the mine. And that estimate was somewhere between $12 to $15 million. By the time we actually took possession of that mining operation, we had $50 million in the bank. So that gives you a bit of an indication of what's going on there. From a production guidance perspective, if you look backwards at 2024, and we'll talk about 2024 in the next couple of weeks here from a full operating performance perspective, but really 2024 was a record year production-wise. In fact, the last 2 years at Florida Canyon have been record years from a production perspective. And so anybody who wants an indication of what the next 6 years could look like, it's probably a good starting point, right? 70 to 75,000 ounces a year production. It's not going to be 150 to 200,000 ounces. It's just not that kind of mining operation, but fit for purpose for what we need, which is the ability to produce enough cash to de-risk the other assets without coming back to the market for us. That's huge.
But so if you're talking about 50 million, what is that? Is that revenue? Is that cash in the bank? Is it free cash flow? I mean, how do you term that? What am I looking at?
You'll see the division of that coming up in the year-end financials, which we'll be putting up next month or so. But basically.
Is it basically more than you thought it would be?
Oh,
yeah.
Yes.
And some.
Yes.
Some. Okay.
Yeah.
Okay. Cool. So let's look at some maybe the potential uses of some of that cash flow, some of that free cash flow. You gotta expand. Florida Canyon potential with a bit more drilling. So have you planned that yet? Is there a modeling campaign happening at the moment? Or
we have, and we actually that was all of last week for me, which was sitting down with the mine site exploration crew and our own Integra exploration crew, which is kind of working in parallel now. They're working together. This realization, the penny finally dropped for me that Florida Canyon is really just one large ore body that's been mined as satellites. And so I was always kind of scratching my head trying to figure out these low sulfidation epithermal systems. They're not pods. They're typically one sort of center mass of some kind. Really, what's separating these satellite pits that have been mined over the past 20 years are these saddles. And the saddles, or the zones in between these satellite pits, do contain some very strong indications of continuity, basically linking up these satellite pits into one large ore body, but they just haven't been drilled. I mean, this is a mining operation that hasn't seen a lot of free cash flow to do that sort of thing for 20 years. So for the first time, we'll be doing that. I think we'll be very successful at it.
Well, that's interesting. You're going to come at it that way. So you will kind of give guidance in the next few weeks and months, will you, in terms of what that could look like? Okay. Right. So we talked indirectly about this high price gold environment we find ourselves in. It's really helped from when you started these conversations where you are now with the kind of cash flows. But what are the kind of other operational efficiencies and optimizations that perhaps allowed you to achieve these kind of, what do you say, is the highest in 21 years, you said? Highest gold production in 21 years?
The highest gold production rate since the beginning of the mine, yeah.
So what else were you looking at? What else were you adjusting in there?
Yeah, so there are a few things that we saw in the course of our due diligence, Matt, that were really exciting in terms of tweaks that you could make that could have a big effect. I think the first one is the recognition by the current mine staff over the last 2 years that they could do far more what's called run-of-mine leaching versus crushed ore leaching, right? So in other words, straight from the pit straight to the heap versus pit, crusher, and then heap. So there's a cost savings involved in that. So if you look at the biggest driver for this the last 2 years of record production, it's really that, right? It's basically right now it's about 50-50 between run of mine and crushed ore.
Right.
There's a view there that we could probably do a lot more run of mine leaching as opposed to crushed ore leaching, which could really change the economics really positively and maybe allow us to ramp up production fairly significantly, I think, over the next few years here. So there's that as an optimization. There's the some tweaks maybe to things like pit slopes, for example. So they've been mining at a sort of a pretty constant pit slope angle depending on the pit. So maybe if we can tweak and steepen that up just a bit without obviously being safe while we're still safely operating, there's some savings to things like stripping campaigns that we could be doing. An understanding of just the general geology as it relates to metallurgy, I think that there's some value in that. There's a fleet study which will make a big difference right now. It's a fleet that's fairly aged. So what do we do in going forward? Do we buy some new trucks and extend the mine out, or the availability of those trucks out over time? Do we overhaul part of the fleet right now? What are those options? So there are a bunch of incremental changes here, Matt, that could make a big difference ultimately. So in 3% and 5% increments, but they add up, right?
Right. Are they sustainable? Are these sort of quick fixes to kind of get as much money out of the mine as out of Florida Canyon for now? Will you be able to sustain them in 2026, 2027?
Yes, things like the recognition of more run of mine mining and processing versus crushed ore processing. That is definitely sustainable because we believe we know what makes the difference between run of mine ore from a metallurgical and geological perspective versus crushed ore. And that is certainly sustainable if we can keep replicating it. So that is sustainable. Trucks is just it's basically a binary decision. Do we extend out the existing haulage fleet? Do we buy new trucks? Do we do a bit of both? That is definitely sustainable. That's
rolling into the ground.
Yes,
that's what the army would suggest. Time and motion studies.
Yes,
right. And with that, were there any kind of particular areas of the mine that outperformed in terms of that kind of grade or recovery?
Yeah, the grade is fairly consistent, and it's a low grade ore body, right? It's a 0.35 grams per ton, fairly consistent. There's a sea of that sort of material. I think that there's scope to be looking at maybe lower grade material on a run of mine basis that hasn't been looked at before, only because of the gold price where it's at right now.
Right. Like high gold environment covers up the multitude of sins.
Correct.
Some companies don't bother looking at certain things to eke out those 1% here, 1% there when the gold price is doing that for them. But things like with these heap leach recoveries, you're around just over 60% last year. So what can you do, or is there anything to be done with that?
Yeah, there's a part of the strategy to optimize is to relook at the metallurgy. So we have our metallurgists sort of helping out the mine staff to look at optimizing, maybe eking a few percent out of the recoveries. But my gut says that the biggest bang for our buck from a margin perspective doesn't lie with that. It lies with processing more material, more volume over a fixed cost of what it costs to run the mine itself.
Right. Okay. So agglomeration and finer crushes is not it. It's de minimis.
Correct.
Better places to spend your time and money. Okay, makes a lot of sense. Right. Yep. So let's bump over to DeLamar. I don't want to get. I've asked everything I need to there. That's good. Okay. The feasibility study underway. DeLamar expected later this year. Do we know?
Yeah, mid-year is the plan.
Mid-year.
Yeah.
Okay. And obviously that's now kind of fully financed process. So come back to your earlier comments about. You've got the money to do that and do that properly. So in a way, you don't need to rush that. What are the kind of long poles of intent? Permitting is obviously always the eternal thing, isn't it?
Always, yeah. Permitting is the big sword of Damocles that hangs over every developer, right? And we haven't been immune from that. That said, we're soon to be resubmitting an MPO to start the mine plan of operations. Sorry to use an acronym. Mine plan of operations to the federal regulators that will kick off the NEPA process, which is something we've been talking about for the last 3-4 years now. We're finally there. And to do that in a time when we have a political administration that is the most permissive to permitting in decades, I think is really good timing for us right now.
Do you think this kind of Trump administration is good for gold mining? I know the oil and energy is a kind of big driver for them, but does this also kind of ripple down through into the mining space?
It sure does, Matt. I mean, since the administration's been in power, we've seen what I won't say daily changes, but weekly changes or improvements to the permitting process. There's a bunch of them. I think top of the list for me would be, I'm not going to call it neutralization, but the diminishing of the effect of this bureau called the Council for Environmental Quality, which is something that Trump has really helped to task, which was a Biden construct. Basically, it was an office that was involved in permitting at a very high level of government that was stuck in by Biden, right at the same level as the Department of Interior. They had almost an equal say in whether a project got permitted or not, a metals or mining project. Now, our need to convince them as well as the DOI has been diminished, let's say, significantly. That's really huge for us. All sorts of changes like that. Not only at the federal level, but we're seeing it at the state level. So state level permitting for us is going to become just as important as federal level permitting. And Governor Brad Little of Idaho enacted within 2 weeks of the Trump administration, basically doing something very similar to, I guess, Doge, if you will, which is the sort of the cutting out of bureaucracy. Governor Little of Idaho put together this office called SPEED, which is meant to cut all of that red tape to do with resource extraction and permitting in Idaho. So we're seeing two levels of government, both federal and state level, wanting to go fast, which is music to our ears.
Wow.
Yeah.
Say, well, like no one's talking about taking shortcuts. No one's talking about not doing things to the level that need to be done. It's a question of less bureaucracy is good, and I'm all for that.
Yes.
Right. Okay. Can you remind us of some of the economic numbers around the kind of PFS, and what do you hope to be able to do? Is it just confirmation of those numbers, or can you exceed?
Yeah. Well, so a bunch of things have happened from PFS to FS, right? Is when you get rooms full of engineers, your own engineering staff working in parallel with your consulting engineers, you're always trying to optimize. Where can I cut costs without cutting efficiencies or providing safety hazards or things like that? What we've done is we've recognized that we might be able to bypass one entire level of crushing at DeLamar. So recall that we had primary, secondary, and tertiary crushing in our PFS. We might be able, because of this low-grade stockpile material and a blending strategy, we might be able to bypass tertiary crushing altogether, which lowers CapEx and OpEx really significantly. Tertiary crushers chew through a lot of energy to work. And so if we do that, our not only does our CapEx and OpEx comes down, our power requirement to site comes down, which means we will be able to get away with line power as opposed to on-site diesel power generation, which is huge for the project. So you'll see that in the upcoming feasibility study. Tweaks like that, they'll make big positive differences.
Right. Okay. Again, we're talking about something with 8 years life of mine, although significant annual production in terms of gold equivalent number. So it is meaningful in terms of that output. What work are you going to be doing whilst kind of running up to this feasibility study in terms of saying, well, look, this thing does have potential. It can get bigger, because if this is a cash generative machine that you're creating here, that's one thing. If it's trying to look attractive to someone else, that's another thing. And timing is very different as well. So how do you kind of weigh up that kind of value creation, value generation aspect of what you've got to try and do with DeLamar?
Yeah, I mean, for us, again, it kind of all flows back to this sort of three pillar strategy, which is, we're starting with 70,000 ounces at Florida. DeLamar adds another 140. Nevada North adds another sort of 80 to 90 on that basis. So we're talking close to circa 300,000 ounces of production when everything's up and running, which is great news. But getting back to DeLamar, one of the knocks that we had was the 8 years of mine life from the PFS. That study, recall that we talked about these low-grade stockpiles on site that were previously mined but not processed by Kinross because they were too low grade for the mill. Now that we will be incorporating that material, it's basically 50% more volume at a kind of a similar grade to the in situ there. We'll easily be adding sort of 2-3 years of mine life. So instead of 8, maybe 10 or 11, which is great news from a production perspective.
Okay, what about these sort of tweaks in terms of, because this is a massive earth moving exercise and engineering efficiency exercise, and things like the kind of waste to ore ratios and so forth are really important. So and even kind of, I guess, the mining methods themselves. And so you talk about pit slope design and drill and blast improvements, etc. So what are the things that you're looking at to say, look, I think, given what we're learning over at Florida Canyon, your experience in the past, how do you optimize these things to kind of eke out those margins with, because every percent counts,
Yeah, no, for sure it does. I mean, some of the lessons learned from Florida Canyon, for example, is their drill hole blast pattern, which is kind of the cheapest, quickest way to crush rock in a pit is with a very effective blast pattern and powder factor. And so taking that knowledge that the 280 odd people at Florida Canyon have, and basically saying, okay, we'll drive up the road 3 hours, there's DeLamar, and help us out with what you know from 20 years of mining experience. That is invaluable experience for us to have, right? So it's the application of those sorts of things. How they load, how they blast, the pattern of haulage out of the pits, all of those things. The real time experience, again, from Florida Canyon when applied to DeLamar, I think is going to have some great incremental effects. And again, it's not going to be sort of 20 and 30% increments. We're talking 5 to 10% increments, but that's huge, from a cash flow perspective, future cash flows.
And can DeLamar support this modular or stage expansion, to kind of gradually increase production without requiring sort of excessive, capital up front, or is it just the nature of these kind of large engineering projects?
I think from a production perspective, what you see is what you get from look at the PFS, and the FS is going to be very similar, but that's 140,000 ounces a year. That's no small potatoes, as they say over here. So that's significant enough for a junior producer from an incremental expansion perspective. But where you will see certain economies of scale will be on, again, things like eliminating the need for tertiary crushing, no massive on-site power generation, which means that you're not shipping costly diesel to site as much as you thought you would have had to. I don't know if I answered your question, Matt, but
yeah. Like I say, at the end of this day, is these mining engineers are going to be the ones which kind of eke out those margins. And I just looked at these companies like you, not just in a high price gold environment, but just even when gold was a lot lower, to say, well, they will drive the success of this company, because the mining itself is relatively simple. It's the processing where you make the money. Just in terms of getting just on that, actually, getting that balance between gold and silver recovery. You've got a lot of silver in there, haven't you?
We do. Any way we could optimize silver recoveries obviously adds to the project.
Yeah.
We've done a lot of work on that in the last few years from a metallurgical perspective. There are certain things you can add to your processing to enhance silver recoveries. They come at a cost, obviously, so we've been doing a lot of sort of cost-benefit analysis with that sort of thing. So what to expect from a gold and silver recovery perspective, I think it's going to be, largely speaking, the same as what you saw in the in the PFS, only more detailed in terms of the breakdown of recoveries between oxide, and transitional oxide. You might see more granularity there on the upside.
Right. Okay, interesting. And then with regards to, because it's obviously where it is, I think the expectation in terms of logistics and infrastructure.
Correct.
You're good, right?
Yep, we're good. Perfect segue to Nevada North, I think.
Well, yeah, as well. Yeah, we talk. Well, let's give people the highlights here. It's PEA stage.
Yeah.
Further behind, but
so having Florida Canyon, which you can see if you're standing at the top of Wildcat, Nevada North, looking straight east across the valley, you can see Florida Canyon. It's 35 miles away. Now, I'm not saying you can actually truck low-grade dirt from one to the other. That probably won't work. What you can do is deploy some of that equipment and manpower from one to the other. And that's a huge benefit in of itself, right? So planning out fleet strategies, for example, that are based on a mine life of 6 years, maybe 7 or 8, if we're lucky from an exploration perspective, maybe we look at fleet strategies that will allow us to carry on the equipment usage beyond that for use at Wildcat, at Nevada North, right? That's huge. Being able to tell the people, the mine site workforce at Florida Canyon that, your job just doesn't end, 6 or 7 years from now, because we've got right at 35 miles away, you've got something right across the valley that will allow you to continue for another 8 or 10 years beyond that. That's huge for us. It was actually a big sales point for us acquiring Florida Canyon in the first place. We had to sell ourselves to them, right? Obviously, the merits of us buying them. So they said, okay, well, what are you going to do for us? And straight out of the gate, it was dead simple. We just pointed west. Go west, young man. As they say.
Go west. That's literally what I was thinking.
You were thinking that. You weren't you?
Which was telling of my age and immaturity in equal measure. Okay, so things, again, it comes back to the sufficiency thing in terms of optimizing haulage. It doesn't make sense to haul it up and down, but it might make sense to ship everyone west, clearly. There are those sort of... It's just quite telling. There's a sort of linear progression of gold and silver production here with the way that you kind of built up the portfolio. Obviously, it's early days with Florida Canyon. You're producing cash that will kind of get things moving significantly with DeLamar for sure, and then hopefully. On to Nevada North, which looks like it is a nice project in its own right as well. Building that portfolio up in a time like this, obviously you prove that you can get into production, but you're going to need to generate quarter over quarter production, with no mistakes, and that'll kind of help the reputation. It will probably help with raising capital when you need to as well, won't it?
Indeed, yeah. I mean, if you play out this scenario where everything goes right at Florida Canyon and we're building up a balance sheet, by the time it comes to financing DeLamar construction, so we're talking, we'll probably be looking at financing strategies 2 to 3 years out from now, doing so with a healthy balance sheet, with a mine just down the road, with the expertise to build that mine, really does a lot to de-risk things, I would expect, from the perspective of the lender, right, who's going to provide that debt capital in addition to the equity that you've built up alongside. Again, another de-risking element that Florida Canyon brings to the entire mix, which was a big reason why we acquired it in the first place.
Okay, well, I guess in terms of technical and I guess environmental as well, operational, financial, for a helicopter view on this, it's nice to get reintroduction to the story. And we've spoken to you guys a few times, but it feels like this is a major step change for you. It's a major opportunity for you, guys, and there's cash to actually back that up as well. You're producing that cash. That's a question of seeing what you guys do with it this year. So 2025, I guess the big moments for you will come around the feasibility for DeLamar, and obviously seeing. So I didn't ask on the economic studies with the NEPA at the moment. What's the sort of next step there?
At Nevada North, you're asking?
Yeah, Nevada North. Yeah, I'm asking. Sorry. Yeah.
So there's a number of things that we have to do with which again, sort of 6 months ago, in the absence of this cash flow, we wouldn't have been able to even contemplate. Which is, what do we do? What do we need to do to go faster on Nevada North? Which is getting it from PEA to PFS and getting it into the queue ready for permitting. And so there's a lot of work to be done there in terms of hydrogeological drilling and studies to be done. There's the commencement of baseline studies to be done. There's geotechnical engineering work to be done. That's not going to cost a lot of money, but now that we have a treasury like we have and cash flow to back it up, we can actually think about these things. How do we fast track Nevada North? From a permitting perspective, the belief internally is easier to permit relative to, say, Delmar, because it's a smaller project, far less surface disturbance involved. We're not getting anywhere close to any water table of any kind. So maybe we can sneak in from a permitting perspective under an EA as opposed to an EIS, and that saves 1 year. And there are plenty of precedents in Nevada for that. So again, we've got the cash to do that. Now we need to execute on it.
Okay, and I mean, you're treating that pretty seriously. You've appointed someone specifically to look at that, like Dale Kerner.
Yeah.
I mean, because there's a process. You talk about, obviously, it's a better environment with Trump's administration, but there's still a job to be done.
Yeah, I mean, so Dale again, and talk about sort of fortuitous things landing on our doorstep. So in search of a permitting lead that has kind of been there, done that, sort of Dale turned up. Dale delivered the record of decision on Stibnite, which, as you know, was a project that was not easy to permit. Perpetua-owned project in the state of Idaho. So, Dale had just come off of 5 years of working with the federal regulators, with the state regulators, knows how to position a project appropriately, knows all the people involved in that process. For him to take control of our permitting was huge, to essentially leave Perpetua. And they were, quite frankly, I mean, they're at the end of their permitting stage. So, his use there was diminishing, but his use for us will jump to the top of the list, right? Because it's really everything that we need to do for the next couple of years on the two development projects is permitting work. And having Dale lead the charge on it, that's huge for us.
Right, and obviously, I think you announced also that you're going to be chasing down a COO as well. You're a producer now. You're going to, obviously Delmar moving along the phases quickly. That's important for you. That's a big step.
Sure is, yeah, and expect to see that in the next few weeks here.
Okay, like it. Okay, George, brilliant to see you. Great to get the update, and nice to see you in the producer category, and maybe start getting the recognition that you're due. Appreciate your time today. Thank you.
Matthew, thank you very much.